If you are not a contrarian, you're destined to be a victim. And if you save in dollars, you're destined to go broke.
Hey everybody, welcome back to the channel, All Things Business. Have we got a good one? I mean, a real good one. We have one of the fan favorites, and this guy is one of the most intelligent guys in the industry with gold and silver, and we're so happy to have him back on the channel today. My dear friend, Mr. Andy Schectman. Andy, you there?
Yes, I am here. It's good to be back, my man. Thanks for having me.
Great to have you. Hey, everybody that doesn't know Andy that's watching the channel and haven't seen him before, Andy's the president owner of Mile Franklin Metals, started and got trusted since 1989. That goes back with some history. He got started when his dad gave him his first order for silver, and he said, every week, son, start collecting and start stacking. And ever since then, he's been doing it. Am I right, Andy?
Haven't missed a 2-week period, and it'll be 36 years this February. The best gift I've ever been given, to learn the laws of compounding and have them work in your favor instead of against you. And yeah, that is true.
Yeah. Well, listen, my friend, we first met a couple of years ago here in Vegas at the Silver Symposium and got to chatting and talking. And you're just one of those guys that are just have so much credibility, what you say, with thousands and thousands of followers. And we would thank you for your time. Tell us a little bit what's happened with the silver market in these days that you see in gold.
Well, I mean, the metals markets right now they're crazy, to be succinct. You have, I mean, I guess you could start if you're talking about silver. The US government has labeled silver a critical mineral, reclassified it a critical mineral. They put a floor under it, a policy floor. And that's something that, I don't think we can put a price tag on. At the same time, China, the world's largest producer and consumer of gold, and right up there, maybe number 2 with silver, has come out and said that they are going to limit silver exports, and every ounce that leaves the country will have to be permitted through Beijing. We are seeing silver in what's called backwardation, persistent backwardation. Now, this is relevant because typically silver is never in backwardation. What backwardation means is that the price of silver today, the spot price, is higher than the futures price. Normally, it's supposed to be the other way around. It's called contango, where the futures price is higher than the spot price. And that would be just logically the cost of insurance, the cost of interest, in other words, cost of money, the cost of storage. And so as you go further out into the future, the price goes higher and higher and higher. What this is telling you is that there's tremendous demand for physical metal now. It's a lack of trust, really, in my opinion, or it's big traders that are caught offside on the wrong side of this. And we've been seeing more and more and more of these contracts stand for delivery. And when you push around the price with paper, if no one stands for delivery, it's an easy game. But if all of a sudden, and we've seen this exponentially increase both on the COMEX and on the LBMA, they say, now, you know what, we want the silver and we want it now. And that is changing the narrative. These paper promises are like, oh no, now what do? We got to get, and the cost goes higher, as do the lease rates. So you could go to another player in the market, I need to borrow or lease some of your silver to make good on this. I'll pay it back later. Well, the rates have been climbing. So it makes it really unequitable. And it's a very interesting development, considering that the December contract goes into delivery on the 28th in a week. And so to see it in backwardation at all is crazy. To see it this close to delivery is frightening for a lot of these players. And so if the futures price was in contango, if it was further out, as you get closer to the delivery date where the contract expires, the futures price and the spot price converge, and they're the same. But if we are in backwardation, the futures price or the spot price is much higher than the futures price. We got a problem. And it's going to cost you more money to get that silver to satisfy that delivery request. And that's something that I'm sure is shaking a lot of the short positions in the market. At the same time, we have India's silver imports up 500% year over year. The world is accumulating silver. The Central Bank of Saudi Arabia took a huge position in SLV. Now, I hate even saying that because SLV sucks, but at the amount that they purchase, they would be able to stand for delivery. You have China, the second largest producer in the world, flying all around the world to, in particular, Peru and Mexico, buying doré and concentrate. Doré are crudely refined bars before they're purified by a refinery. And concentrate is the byproduct sludge of all of this. They're buying it, paying double what the West will, shipping it back to China for refining. Now, why would the second largest producer in the world of silver do this when it's just a metal that's only $50 an ounce? There's a lot more behind the price, and I think the bottom line is that people want physical silver now, not later. Inventories are getting tighter. Immediate demand is outpacing expected supply, and this stuff doesn't happen unless something's off, and usually comes right before a pretty decent size move. And I think you realize that the big money typically positions before the crowd. It tells you the reset is already underway and the rotation into real assets has begun. Now, when you talk about gold, the same thing is true. Massive delivery since November of last year, since Trump won the election. We become net importers of gold. Massive, massive, massive deliveries of gold coming into the COMEX. And I think, people need to understand that these traders, which, the central banks have been doing it for a long time. Now you have the institutional traders here in the United States. And these people do not do things, pardon my French, for shits and giggles. These people understand what's coming. At that level, when you're spending over 200 billion that we know of just coming into the US in gold and silver since November, and I say that we know of, was just a report that came out that said these central banks are reporting at best 1 in 3 transactions to the IMF, which is not mandatory, it's voluntary, and no one's reporting it. It's a race to accumulate real metal. It really is. And when you talk about something that I've never seen before, kind of to put a bow on all of this, that I think underscores what's going on. Now, I'll give you 3 examples. And these 3 examples are speaking to the highest possible level of sophistication, the institutional traders, okay? Number 1, first of all, keep in mind that Wall Street has never acknowledged gold. And at very best, you'd get an advisor say, fine, 5%. They've never acknowledged it. You have the chief investment officer, head honcho, top of the firm, chief investment officer of Morgan Stanley, who said, Wall Street's used a 60-40 model for the last 50 years, 60 stock, 40 bond, blissfully whistle Dixie into retirement with that portfolio. No, she says, sell half of your bonds and buy half of it with gold and silver. She said gold, but let's just say 60% stock, 20% gold, 20% bonds. That's a big deal. Michael Hartnett, the head analyst for Bank of America, whose newsletter is many thousands of dollars and goes to the institutional traders, no, he says 25% gold would be better. And Jeffrey Gundlach, the bond king, who's made his living selling bonds, says 25% in gold is not overweight. So not only do you have the institutional traders, that being the central banks, the most well-funded and more importantly, well-informed traders on the globe, been gobbling up and standing for delivery gold and silver and basically anything that is strategic for the past several years. Now it's come home. And you're seeing it here in New York. You're seeing it here in the United States, and no one's talking about it on mainstream. No one's understanding that there is a massive influx of metal coming into this country. So much so that it should be front and center news on the mainstream, but not a word. The people who are doing this, I would just like to say, not only do they have the most money, they know the playbook. They have the most information. And at that level, you don't spend that kind of money unless you have a very good idea what's coming next. So, yeah, I think that price, which is volatile, is a tool of misdirection. You can see just by the purchases, the inflows, and the drawdowns in available supply. Things are getting pretty crazy, if you ask me, Al. This is just the beginning.
Yeah, it looks like the LBNA, and also the Shanghai exchange is drying up with money. I mean, the gold and silver out there on those exchanges, and people are taking delivery of it, and the flow is
That's
coming
correct.
to the United States. Yeah.
In years past, less than 1% stood for delivery. Now all of a sudden, bang, everyone's standing for delivery. It's the Achilles heel of the system. If you have a system that's all about paper promises, you can rehypothecate to the nth degree. In London, they assume somewhere in the neighborhood of 400 paper contracts for 1 ounce of gold. That's rehypothecation, selling the same thing over and over and over and over and over and over and over again. If that picture behind your head was a delivery certificate and gave you the ability to go to London and say, give me my bar, rehypothecation would mean that there are 400 certificates just like that with the same numbers that 400 other people own. And they think they can do the same thing. But if no one ever does it, what does it matter, right? Until they say, nah, I want it. That's why we see backwardation. No, I don't want to roll it. I don't want to roll it forward another month. I don't want to settle for cash. I want the metal. Ooh,
Yeah.
problem. And that's where we are right now.
Yeah, it's like musical chairs, and the music stopped, and everybody wants their silver and gold.
And there's not enough chairs. That's right. More asses than chairs. You got a problem.
That's right. Let me ask you a question. This has been a very debated question for a while. Give me your opinion. What do you think was happening to Fort Knox? So it hasn't been audited since 1954. What do you think? You think the gold's there? Or you think it's not there? What's your opinion?
Whether it's there or not, there's a high probability it's been leased out. But the reluctance to audit it and be open about it signals something ain't right. There was another senator that just is proposing. Just yesterday, I saw it. I don't have the info in front of me, but there's another senator who is proposing to actually do this. He's writing a bill trying to get it done. I think anytime you're not open about something, no, just trust me, really. Let me see your phone. No, but trust me. Let me see it. No, that's the point. It's like, okay, well, where were you last night? I was there. Well, let me see. No, trust me. I mean, on a personal level, if your kid came home and said that, let me see your phone. No. Well, really, the point of it is that if you're not open and you say you're going to do something and then you don't do it, and then you just let it go away, I don't know. To me, it's an indictment, and maybe that has something to do with all the gold coming in, but which would be a problem in and of itself, because the gold at Fort Knox is not 24 karat gold. The bars that are coming in are. Why isn't the gold at Fort Knox 24 karat? Because much of it came from the gold confiscation of 1933, which was melt gold. The gold coins that were used in circulation are not 24 karat. They would deface and bend too quickly, so there's alloy in it. So in theory, if all of the bars at Fort Knox are 24 karat, we got a problem. I don't know how they get past it. I don't know what they do. And it's not just opening the doors, right? And it's not just Fort Knox. There's gold at the Denver Mint, at the New York West Point Mint, and one other place. I forget. There's 3 places. Maybe that's it. But all 3 need to be audited. They have to be. And it belongs to the American people, and it is the foundation of trust of this system. If it isn't there, what does it say about trust? And I could argue this whole system, I can give you several really scary examples of where trust is breaking down, in particular in the banking system. But if you look at the futures market, I don't want to roll my contract over. I want it now. That's trust. Everyone leaving the dollar and de-dollarizing, not taking the treasuries. Why? Because they fear sanctions and retaliation like we did to the Russians. That's trust. They don't trust us. A system that is based on trust. Or maybe they don't trust our fiscal irresponsibility, where in the 6 weeks that we were closed as a country, the government was shut down, we added 500 billion to the treasury. The last trillion was added in 71 days. A trillion seconds ago was 31,688 years ago. We are wholly fiscal irresponsible, and the rest of the world doesn't trust us anymore. Now, this is moving into the banking system if you want to go down that road at some point, but there are some scary things happening, and it's all about lack of trust and transparency, whether it be Fort Knox, de-dollarization, don't want the treasuries, the banking system, or the COMEX and LBMA contracts that have always cash settled or rolled over. No, I don't trust you. Give me the real thing now. And that's where we get into a problem.
Well, I think that's why the BRICS came along, because of trust. They saw what happened to Russia, and they all come together, and now they're
exactly right.
Accumulating more and more countries to the BRICS. So speak on that. That's the breakdown of trust, and we're using the big stick to beat countries up and threaten them. And if you don't go along, we're gonna sanction.
And those tariffs that they talk about? I'll give you a 500% tariff if you support Russian oil purchases or any country that does. That's not a tariff, that's a sanction. And so tariffs masquerading as sanctions. And that's right. The stick sometimes isn't the best choice. And so it's a system where, you know, it's coming back full circle now. People are pushing back against a system. And when you lose faith and trust in institutions, the Justice Department over the last several years and the previous administration, the look at the Federal Reserve, 2 or 3 of their, you know, their board members have been disgraced with trading illegally. Look at the Supreme Court, questions about that. Look at our immigration policies. Look at our markets. Look at our fiscal policy. I mean, all of these things, and the geopolitical aspect. Yeah, we're going to sanction you. And when you look at the rest of the world, now I want it to be clear. I'm a patriot. This country's done more for me than I ever could have imagined. And I thank God I was born here every day. I vote for Trump again, simply because I think his policies are the best. But you know, look at the way the rest of the world looks at us, Al. We invaded Iraq 22 years ago under false pretenses. There were no weapons of mass destruction. We destroyed their country, toppled their regime, and guess what? We're still freaking there. 22 years later, occupying the country. And they made in 2023 $900 billion in oil revenue. They don't even get to control it. The money's held at the New York Fed. I mean, yeah, we'll give it to them, I suppose, but it's just not a good thing. The world looks at us as being hypocritical, where we can do these things, but you know, and we were supposedly the good guys. We're higher moral ground, and you look around us, what moral ground, and what higher moral ground, and the world says, yeah, they can do it, and they can be judge, jury, and executioner to a country like Russia. And I'm not passing judgment on it, but why is it okay for us to do these things, but not okay for them? And the moral of the story is, as the world reserve currency, it shouldn't be up to us. It should be up to world opinion. And it's creating a problem that, yeah, we may be in their good graces today, says maybe Saudi Arabia or a country like that. But hey, what does tomorrow look like? How about Japan dumping treasuries? How about China dumping treasuries? What does tomorrow look like? And that's, I think, one of the issues that the world is facing. And now it's going through all areas, institutions, markets, political figures. Where does it end? And I think that's kind of the problem. And this is the rise of blockchain, where it's transparent, and the rise of commodities again, because it's transparency, and it is, you know, what is gold and silver but an asset that is not simultaneously another person's liability. There's no counterparty risk. You don't need to trust someone when you hold an ounce of gold, but any certificate you have, anything that is a security, well, there is counterparty risk. Same thing with the bank account, insurance policy. There's counterparty risk all over the place, and it's accelerating. And I think that risk is getting more and more acute. I think you'll see that happen more and more, and you can see it in various areas of the economy right now.
Yeah, let's go down the rabbit hole of banking. What do you see the problems with banking right now that people are not aware of? Because, you know, 80% of the people, they don't want to know, they don't get it, or they get on there late, but they don't see it coming, the cracks coming. I mean, you see it, I see it, but give us a vision of what you see with the banking system.
Yeah, I think something is happening beneath the surface of the entire financial system. There's something called the repo market, and the repo market is it's where, if I'm a bank and you're a bank, we lend to each other overnight. This happens all the time. Maybe one bank, like a regional bank in Minnesota, let's say like US Bank, which is a pretty big regional bank, but there's a lot of, and this is hypothetical, okay, this isn't happening, but what it is happening, but not this story, to kind of make it easy to understand. There are a lot of Fortune 100 companies in Minnesota. There's where my corporate office is located. We're not one of them, but there's Medtronic, there's Boston Scientific, Best Buy, Target, not General Motors. What is it? It's not Pillsbury. What am I trying to think? Well, it doesn't matter. Let's just pretend that Best Buy and Medtronic and 3M and Target, they're all, let's just say all their payroll runs through a US bank, and they don't have quite enough money to come up with $100 million in salary for all of these institutions. They'll have it tomorrow when their things settle. So they will borrow money from another bank in the repo market, and they will pledge securities. Typically, it is mortgage-backed securities or treasuries as collateral. And then they will buy it back at a higher price, just a little bit of an interest rate, the next day. It's literally overnight, so they can fill that funding gap. Well, that's the repo market. And normally we don't hear anything about the repo market. That means it's working. And when it's quiet, it means everything's okay. Can you call the repo market the plumbing of the financial system, where, again, literally overnight, they're borrowing to one another, keeps everything flowing, right? So over a 5-day stretch over the past 2 weeks, the Federal Reserve injected $125 billion into the repo market in an effort to ease funding stress, they say. Now, there's no one talking about this, and they should. It's a big deal because let's go back to 2008. The repo market blew up because there was a lack of liquidity when Lehman Brothers and Bear Stearns fell and they needed to pour money into the system. Lack of liquidity. In 2019, we hear of this repo market crisis where interest rates in the repo market went all the way up to 10 or 12%. And there was a lack of liquidity. So the Fed injected a bunch of money into the repo market, the overnight lending market, right? Both of those were very, very big crises. Now, right now, what's unusual is that there is twice the amount of liquidity in the system right now than we saw in either of those two occasions. There's plenty of money, right? And consider what we see right now in terms of how severe this is. You turn on your water on any faucet in your house and you hear a boom, 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 boom in the walls. Something's not flowing right. And again, what makes this concerning is that there's twice the amount of money in the system than either of those two instances, in particular, 2019 repo crisis. This is not an out of money problem. This is I don't trust you problem.
Exactly.
Because banks have twice the reserves they did then. And the Fed rarely, if ever, would inject liquidity into the overnight market when reserves are this high. In this environment, injections by the Fed should be zero, right? And so what it basically is happening is the banks are looking at each other and they're saying, no, not lending to you, not even for one night. And I'm not sure you'll be able to pay back tomorrow morning, or maybe your collateral sucks. Maybe those mortgage-backed securities suck. And this matters, right? Because repo stress usually happens only right before some form of a correction. And I would simply say to you that, look, in normal, if there's a little bit of stress, 5 billion, maybe they would inject. A good deal of stress, 10 or 15 billion. 125 billion is crisis level injection of cash. And it signals that the banks don't trust in each other. Now, let's take that a step further. Who holds all the big contracts on COMEX and the LBMA? Those same banks. They don't trust each other. What about the rest of the world? Well, they don't trust us either. They're dumping our treasuries because of sanctions and fiscal irresponsibility. Do you see how trust is eroding? And it's starting to splinter all the way down. Now, the entities that use the repo market aren't just the banks. It could be a big hedge fund, and it's got collateral. But I don't want your collateral. I don't trust that bundling of commercial real estate or residential real estate. There's too much in the way of foreclosures. We already saw the big stress in the auto lending market, where the high risk auto lending market is breaking because there are more late delinquencies than ever in that market. And so they get bundled up and sold as a security. And then what kind of collateral is it? So we're beginning to see signs of stress, and they're very quiet about it. But if you understand that 125 billion is pulling the fire alarm,
wow.
I don't know. It's just something that has me very concerned. And the whole system is beginning to show cracks in the trust that supports a system that is based on nothing but trust, no longer backed by gold. Trust us. Even the full faith and credit of the United States government. What faith? What credit? We're broke. We're insolvent, and we're 38 trillion in debt. But that excludes Medicare, Medicaid, Social Security, and government military pensions. Another almost 200 trillion, and a trillion seconds ago was 31,688 years ago. So the whole system is breaking, and I think people should pay very close attention to that, because the changes in the Dodd-Frank Act say that if you have over the FDIC limit, which is a joke anyway, about 150 billion backing 17 or 18 trillion in deposits, like 7 cents on the dollar, but anything over it, you are an unsecured general creditor, i.e. last to be paid, and you will be bailed in rather than bailed out. So the money that is over the limit goes into the kitty to bail in the stupidity of the bank, and you're not insured anything over that amount of the FDIC limit. These are scary times. People should pay attention. I don't sell metals based on fear, but I mean, let's just be honest. There's a fine line between pessimism and realism right now, and I think to ignore this is putting your head in the sand.
Yeah, before we had the bailouts where they bail the banks out, and the bail in is when our money or your people around the country who's got money in the bank, you got worthless bank notes that's not worth anything because they took your money. So
and when Silicon Valley Bank and Signature Bank failed, it was illegal, and there was a Senate subcommittee hearing. And ironically, the senator from Oklahoma said, "Let me get this straight, Madam Secretary." It was Janet Yellen at the time. "You just bailed these two banks out. The Dodd-Frank Act says you can't do that. It's illegal. What am I missing?" "You're right, Senator," she says, "but myself, the President of the United States, the FOMC, that's the Federal Reserve, and the FDIC deemed in an uber majority vote," as she said, "that this was too systemic to the system." They had Oprah Winfrey's money and the tech startups and all the big Hollywood money were in these banks, and they had billions in uninsured deposits. Idiots, but they did. And so they bailed them in and said, "But it won't be on the burden of the taxpayer. The FDIC will cover it." Yeah, right. So they bailed them out. And he said, "Well, does that mean if there's a failure in a regional bank in Oklahoma, my constituents will be made whole?" "No, Senator, they won't. They would have to have that same uber majority vote." Now, here's something no one heard about. If you Google First National Bank of Lindsay, Oklahoma, and they bury it, you may have to really dig for it. Failure. Late last year, maybe the year before, time's flying so much. Little old podunk Lindsay, Oklahoma bank fails. They only had 7 million in uninsured deposits. Now, anything uninsured is supposed to be gone. Now, maybe to not rock the boat, they decided to give them half. And there were two news stories. There was a small regional Fox News channel that wrote about it, and it's on the FDIC website. But it went something like this: you have $1 million in the First National Bank of Lindsay, Oklahoma. It fails. There's 7 million bucks in uninsured deposits, right? So basically, they get a letter that says, "Today, First National Bank of Lindsay, Oklahoma failed." Always on a Friday. Always going to be on a Friday, because ain't nothing you can do until Monday. And it says the First National Bank of Dunklin, Oklahoma will take over. Your insured deposits will be made available first thing Monday morning. Your uninsured deposits, half of them will be. The other half, if assets are greater than liabilities. Now, earlier in the story, it says the assets were way less than the liabilities, but it said if the assets are greater than the liabilities, that other half over the next 4 years could be paid to you in the form of Duncan, Oklahoma bank stock, the First National Bank of Duncan bank stock, not even the cash. So let's play that out. $1 million, you're going to build a house. You're ready to buy it, and bang, it fails. That 250 that you have insured, you get it. That leaves 750. Half of that 750 is 375. You get that too. That's 6.25. That other 275, bye, gone forever. You're never going to get it. And if you do 4 years from now, maybe in the form of bank stock, the minute everyone gets it, bang, they're going to sell it, and the stock collapses. So all I can say to you is that, and that happened, and they should have got nothing over the 250. But they don't talk about it. Everyone knew of Silicon and Signature. Why doesn't anyone know about Lindsay, Oklahoma? Do your own due diligence. Check it out. Being in a bank over the FDIC limit is as silly as a mud wall right now. And especially when you see the repo stress, that to me is a big, big issue that plays into everything moving forward.
Yeah, it's so amazing. Man, if people would understand what you said and keep it simple and move their money, gold, silver, and start stacking, and also, like I said, just wake up and start smelling the coffee. Because I want to ask you this question: what do you see coming forth in 2026? What do you see that year looking like?
I mean, it's hard. I don't mean to brush it off. It's just hard. But I will say that it's hard for me. I look at the big picture, and in terms of probabilities. But I will tell you, Judy Shelton, who was on my podcast twice in the last 6 months, she was Trump's nominee to run the Fed. She did tell me that July 4th, 2026 is a huge day for him. It represents the 250th anniversary of the country, and that he plans on backing the back end of the treasury market with gold um, at that date, which would be very big. And that, in essence, to regain credibility at the back end of the bond market, the 5, 10, 20, 30 year, and she even said 50 year, where they would make it redeemable in gold instead of interest. And there's a whole long thing about that, why that would happen. It's all intertwined with the Genius Act that's been proposed. But I'll say this. One, silver has been reclassified a critical mineral by the US government. Two, the amount of gold and silver coming into the country over the last year is off the hook, and it's the biggest money in the world bringing it back in. Three, you have the Treasury Secretary, a self-proclaimed gold bug. You have Judy Shelton saying they're going to peg gold to the Treasury market. I could keep on going, but I'll just simply say this. When the central banks have been front running this for the last 5, 6 years, I think that moving out into the future, you're going to see gold and silver much higher than people think possible, because it is going to be reintegrated into the system. In the BRICS, they're using it as a settlement system. In fact, I've talked a lot about mBridge, the cross-border payment system that allows countries to trade with one another free from SWIFT intervention. The first trade happened yesterday, I want to say, where it is now fully optimized, where the central bank from the UAE traded with the central bank of China. Now let's play that out. China would buy oil from the UAE and use digital yuan and trade over mBridge, which is a cross-border payment system that settles in 7 seconds at a 98% reduction in fees, no SWIFT intervention. The digital yuan has been made immediately convertible into gold. You don't have to go to dollars first. By the Chinese government. They are building, the Shanghai Gold Exchange is building a series of multi-jurisdictional vaults all around the Belt Road Initiative for this purpose. The first one was completed in Hong Kong. Hong Kong, in order to take gold out of China, has to go through Hong Kong. So the UAE could take those digital yuan, send it to the Shanghai Exchange, and boom, take the gold right away. The second one is under construction right now in Saudi Arabia. So the Saudis can do the same thing, take the gold right out of the vault right there. And they're building them all around the Belt Road, which is 150 plus countries, 70 plus % of human population, 50 plus % of global GDP. It is what they plan on doing. They will trade with everyone over a cross-border payment system that is free from the SWIFT, that the dollar is not compatible with, and they will settle trade and currency imbalances in gold, which is tier one. And this is why they've all been buying it. This is why they're setting up the rails for it. And the only way the US can compete is to peg the treasury market to gold and let go of the reserve status of the dollar, because of something called Triffin's dilemma, which is a theory that says as a reserve currency, you'll always run trade imbalances. The world needs more dollars, and we can give them through trade alone. Your manufacturing will die, because as more and more countries have to buy dollars to buy oil and stuff, they have to sell their currency to buy ours. Ours gets high, theirs gets low. And over time, it's just so much cheaper to have your stuff manufactured in other countries like Vietnam or China, because of the strength in our currency, that your manufacturing gets hollowed out. Now, what did Trump say in his press conference yesterday? We brought back 18 trillion in manufacturing. We're going to get it all, establish new facilities and this and that. Great. You can't sell it to the world unless you get rid of the reserve status. What did the nitwit dinglebat previous chief economic advisor for the Biden administration say, Jared Bernstein? Watch him on X trying to explain how treasuries are made. It's the most humiliating thing I've ever seen.
It's funny.
But he wrote a report called Dethrone King Dollar. He advocates we can't be the reserve currency anymore. It's killing us. Vance, vice president, just wrote on White House letterhead, same thing. It's been a boon for the consumer with cheap goods and low interest rates and high asset prices. Everyone buys our treasuries and uses our dollar to buy, to buy everything. And we take, we get the benefit of cheap price goods, but it's killing the manufacturing. It has to end, and it will end. And I think the way you do it is by letting gold go to the moon. That's all the talk of the gold revaluation. This is Tether, who issues stable coins on the Genius Act that's backed by U.S. treasuries. the interest on the treasuries is not transferable. Tether already has 13 billion in gold. And who's the CEO of the new Tether stablecoin division, USA Tether, but a man named Bo Hines, who was Trump's crypto czar till August? Wink, wink, nod, nod. You're going to buy gold and we're going to work out a deal. Maybe that gold will end up in the treasury. You're going to make a fortune, but you are going to take the interest that you keep on all the movement of stable coins backed by U.S. treasuries. You're going to buy gold. You're going to buy Bitcoin. I think Bitcoin will be used to pay down the debt, so you'll get rug pulls constantly. And I think gold will go to the moon because that's what they want. Because a higher gold price means a devalued dollar price. How do you sell your goods to the world? In a devalued dollar. Even Wall Street, even Main Street's talking about it. The news is saying the debasement trade, the debasement trade. They want to debase the dollar, which means let it fall in value so they can pay down the debt and bring back manufacturing. How do you bring back manufacturing at a zero upfront cost? I know. You back the back end of the treasury market with gold, 5, 10, 20, 30, and a 50-year that Judy talks about, redeemable in gold, no interest, no upfront borrowing costs. And now you can bring back and build new facilities with no upfront borrowing costs and 20 years deliver the gold. What if the price of gold goes way up by then? Oh, that's easy. Not only does it benefit all the central banks of the world who've been buying it, it benefits us. So the moral of the story is you save in dollars, you're going to go broke. And you can take any asset you can think of, anything, and go back 20, 50, go back to 1971 and take what that asset cost in gold then versus what it costs in gold now. And you'll see prices on everything are falling in gold terms, but they're going way higher in dollar terms. And that's the point, is that the dollar, which we measure things against, like right now, the dollar is down 7 or 8% against the dollar index. Yet it's down 70% against silver and 60% against gold. Gold and silver are the real barometers, not a basket of crappy currencies. So don't save in dollars. The biggest money in the world is repositioning into commodities right here in front of us. And now the U.S. government is doing so as well. And it now becomes a policy issue and a national security issue. And I think we haven't seen anything yet. Honest to God, I believe that.
Wow, that's a lot. I've been stacking since 1998, and I'm a happy camper, and I totally agree with you. You said something that I'm going to quote. I'm watching on another channel recently. You said this: "Buckle up for what's about ready to happen to silver."
Yeah, because the U.S. government just classified it a strategic metal or a critical mineral. China is now massively curtailing exports. The exchanges are bleeding silver every single month, including the COMEX, and the LBMA, which is in backwardation, meaning there's more demand for the bars than there are for the contracts. Right now, this is structural, and it's getting worse. I think silver has not been allowed to express itself in price because the military industrial complex has been holding it down. And that's not just in the United States, that's all around Western Europe. They've held it down to build high-tech weapons. And you need huge amounts of it to build high-tech weapons. And the countries that have exploited the delivery mechanism over the last few years for a long time were not sophisticated, coordinated, or motivated enough to do this. They are now, and wealthy. And, you look at India, you look at Saudi, you look at China, you look at Russia. They're all massively buying silver. And they have been doing so because they know it's the Achilles heel of this entire Western system. And, because why? Because it's the big Western banks that are massively short. Well, okay, so they blow up on their silver holdings. Really? They have holdings everywhere. Remember going back to trust? Well, if they fail to deliver on silver, what does it mean about their interest rate portfolio, their equity portfolio, their FX portfolio? It means I'm getting away from that bank. And it's a bank run. And the systemic contagion is who knows where it goes. This is why I think you're seeing a lot of banks trying to exit gracefully from the short position side. Someone's going to get left holding the ball. But when you see, literally structural backwardation since October that we still see now, I've never seen that in silver for more than just a couple of days. Now we're pretty much going on 6 weeks for the most part, with a brief moment or two of it going into contango, which means that's normal. Spot is lower than futures. It's signaling that there is great tightness and stress in the industry. And you can see the exact same thing with SLV, where to borrow the shares, the it had gone up to 20% borrow rate. Well, who's going? And you would borrow them in order to cover, right? And because you can short SLV too,
Sure.
which has the same effect. And if no one is lending the shares, there were zero to buy last month, zero across the globe. And if you could find them, the rates were at 20%. The lease rates to buy bars or to borrow bars from the LBMA went up 200% at the same time during the last delivery cycle. Are we going to see that again now? I don't know. We'll find out in 7 days how many of these contracts stand for delivery on the 28th of November. It should be a very interesting day to see just how many stand for delivery. I'm expecting a lot. I think silver, look, Bank of America said $67 next year is their target. That would be a low end. And if you take the cup and handle, which is a 45-year formation that we've seen technically, you take the top of the, once it breaks through the 50, which it did, you take the top of the cup and the bottom of the cup, 50 and 4 in the early 90s, 50 in 1980. The difference is 46. You add it to the top of the cup, 50 plus 46 is 96. Technically, that would be the next target in theory. Are we going to get there? Don't know. But I would argue it has never been allowed for as long as I've been doing this for over 35 years to find real price discovery because the banks have been naked shorting it. But now they are challenged by countries and institutions and sophistication that it never had challenged before. And they're standing for delivery. No one ever did that. None of the traders did it. None of the players did it. It was done typically to hedge positions, right? A miner who's pulling metal out of the ground and won't have it for months can forward sell its production, get paid, and then when it's done, deliver it. That's typically what it's used for, right? To hedge exposure. Now they're saying, yeah, you know what? We're going to stand for delivery instead. And the heat's getting turned up quite a bit. So, yeah, I would expect silver to, I would call it the value of a generation. And I say that with as much sincerity as I can give you. This is not about telling people to buy silver from Miles Franklin. Sure, I hope you do. But I'm telling you, buy it no matter where you buy it from and get it in your possession because the biggest money in the world is making an overt attempt to do just that. Don't do what the talking heads say. Do what the biggest money in the world is doing and get it in your possession.
Like to say, follow the money, follow the money, follow the money.
Man.
You know, so much of the dark pools out there and the private equities and solvent wealth going in and, offices is going, I mean, they're just, going deep, deep, deep and buying a lot, accumulating a lot of gold and silver right now. Let me say this, I know you, I follow you a lot, and, you and Rick Rule are just two of the most amazing guys in that industry, especially yourself. And I know how you feel about Rick Rule. So you guys are just, I'm just glad to have you.
He's been very good to me. Rick is someone I owe a lot to. And if you're listening, Rick, I love you. Thank you.
Rick, we got to get you on here. Because I tell you what, we just want to thank you for your time today. Before we close out, give us a little synopsis of, we're closing out this year, going into next year. And I know that metals are taking a little bit of breather today, but they're poised to continue rocket shipping up in price. And I'm in the same camp you are. So in closing, give us a few words in closing for new people out there looking around the world that are just seeing you, some may be seeing you for the first time. What would you have to say to those people out there listening today?
I would say that fiat currencies inherently are all meant to die, and the dollar is one of them, and it's being inflated away to worthlessness. I mean, it truly is. Like I said, in the 6 weeks that the government was closed, they added 500 billion in debt, and the last trillion was accumulated in 71 days. It took over 200 years to do the first trillion, and now we're doing it in literally 2.5 months. It's accelerating, and when you realize that a trillion seconds ago was 31,688 years ago, that's a problem. When you realize that the U.S. now has a record 18.6 trillion in household debt, up 60% over the last decade, where auto loan delinquencies are at their highest level in 15 years. Subprime auto delinquencies are their highest level in 31 years. Student loan delinquencies at an all-time high. Credit card delinquencies, the highest in 14 years. In October, 36,766 foreclosure filings. People getting kicked out of their homes. That's 3% higher than the previous month, 19% higher than the same time last year. The economy's in trouble. We talked about the bank. We've talked about all this stuff. You don't buy gold and silver to become wealthy. You buy it because it is wealth that has outlived 2 world wars, the German hyperinflation, the Great Depression, every pandemic, everything.
Mhm.
And that's why you own it. And I think it's time for people to understand that it's time to think outside the box. As Rick Rule, I'll leave you with this, says, if you are not a contrarian, you're destined to be a victim. And if you save in dollars, you're destined to go broke. So it's about assets. He who owns assets is called the Cantillon effect. He
Yeah.
who owns asset wins. And that's what I would tell people to do. Don't save in dollars, save in assets, even if it's an ounce of silver, an ounce of gold, whether it be Bitcoin, whatever assets mean to you, it's better than keeping it in dollars, which are really just being destroyed in value through irresponsible fiscal and monetary policy.
Yeah. We saw it with the Roman Empire. We saw it when England was, when they were the dominant dollars and money at that point. Now in the United States, and now it's dwelling in our hands and it's going eastward.
It is.
So
There is no question about it. I think you're smart to realize that. I would say there's a pattern every time. It starts with governments overspending, like the Romans, like we are. They borrow to cover the gap, and or they debase the coins. They
yeah,
cut them smaller. They take the metal out. Michelle McCory just did an interesting deal on our channel about pennies and what it really means, how they're taking the penny out. But it's more interesting. Watch it. It's a short one. Talks about this. But then after that, central banks print to keep it all going. We see that. The currency weakens. We're seeing that. The insiders move to hard assets. We're seeing that. The middle class gets crushed. We're seeing that. The system resets as its mathematics would demand it. So that's where we are. And this is, the winners in all of this, they're the ones who are closest to the money printer. That's the Cantillon effect. And those are the people who take that money and buy assets as the currency continues to debase. Those assets become worth more in the face of a falling currency. So you're right on that. And it's the same pattern every single time. So Al, let's do this again, man. Let's do it after the new year. We'll check back in and see what's happened. I'm always available to jump on if something crazy happens, but
all right.
it's good to see you and I'd love to do it again. And I appreciate you having me on. And I wish you and your family and everyone out there happy Thanksgiving, happy holidays, and happy healthy new year to you, brother. And I'll look forward to the next time we pick up where we left off.
Andy, thank you so much for your time, my friend. Take care and
You too.
have a nice Thanksgiving. And if I don't talk to you, nice Christmas and New Year's. Take care. Hey, folks
Likewise.
out there, thank you so much for joining in today. Hit the subscribe button if you haven't subscribed already. And please leave a comment. We love to hear comments and share this with at least 7 or 8 people. Take care. God bless. We'll see you soon.